Hello traders, today is the 2nd of May. My name is Hornsey, market energy trading, and today I'll be looking at a week ahead. Starting with the economic calendar, we can see that the week is actually quite busy, so we're expecting to see some forex moves. However, today London session started with the UK on bank holiday, following on from the overnight session where the Chinese were also on bank holiday. So the overnight into the UK session was kind of slow. We are seeing a little bit of volatility because with the lack of volume, prices can move around, especially when we've got quite a big week ahead. Traders going to be positioning themselves, and also we've got the sort of new month, so new orders go in at the start of the month. Okay, 3 p.m. ISM manufacturing PMI comes out. It is expected to come in slightly better than previous. 57.1 was the previous reading. 57.5 is the current expectations. Obviously, that'd be good to see a rise in the US PMI. However, if we look back, 65 was the most recent high. That's above the normal. And if we look here, pandemic lows, 2020 came back down towards 40. Above 50 is expansionary. The average is around 55, so I wouldn't be surprised to see a little drop. Obviously, with what's going on around the world, we are seeing supply chain disruptions, and obviously US PMIs, as well as any other sort of manufacturing PMI, are dependent on supply and demand. If we can't get the supply because there's supply chain disruptions, because of the likes of Shanghai showing that there's 58 new COVID cases, even though they've tested millions of people and they've quarantined anyone that was looking likely to be infectious or being in touch with people that had infection. They thought they had nailed 0 cases within the quarantine areas. However, unfortunately, they're starting to see 58, like I said, new COVID cases come outside of those quarantine areas. So they haven't sort of got a handle of it, and their policy is 0 tolerance. So they're not going to be happy. They're not going to stop these lockdowns until they get to 0. Supply chains going to be coming under some pressure, which means ISM manufacturing, PMIs and things like that also kind of come under pressure. I am expecting it to come down, but with the consensus sort of showing that there should be like a little push up today, that'd be good for the US itself. And, anything above 50 is good anyway. But, I think the long term, or over the next couple of months, we should be expecting a 55 at least. There are worries that the Fed are going to sort of force a US recession with their hawkish monetary policy. And we'll talk about that in a minute. But currently, we're just coming back towards the mean. So we shouldn't be too surprised if we don't meet expectations in today's US PMI. Right, coming down to Tuesday, China's still on bank holiday. Japan also goes on bank holiday. So the overnight session is definitely going to be quite quiet. Looking through, that changes as soon as we get the RBA cash rate statement. We're expecting a 15 basis point rate hike in the RBA cash rate. So that's them reversing their policy. So if we look here, Australian interest rates from the RBA currently at 0.1%. The previous rate to that was 0.25%. So we had that sort of drop back in 2020. They've kept their rate at 0.1, even though inflation's been going up, even though employment's been good, and they're sort of lagging, if you like, Bank of Canada, the Fed, Bank of England. And if we look down to the RBNZ, we can see here, RBNZ have currently got their rate at 1.5, so much higher than the RBA. And they surprised everyone with a 50 basis point rate hike. So looking to see if the, going back here, the rate statement says that they're going to try and catch up. They're going to be more hawkish going forwards. Whether or not they're going to consider 50 basis point rate hikes depending on inflation and things like that. Go to the active trader platform. The Aussie versus the New Zealand dollar here is in this big sort of range since 2015. So the last 7 years or so, been going sideways between parity and 1.15, kind of above the sort of mean of that range. We're looking here from the pandemic lows, March 2020, up to the August 2020 high. That is the trading range that we've been in for since the last couple of years. So if we get back above that, we're into this supply zone. If we go through all of that supply into the 1.15 and above, then we look to the left, Australian dollar versus New Zealand dollar could be at 1.25 by the end of the RBA rate hike cycle. Going down, here we've got Kiwi employment data. looking good, looking for the unemployment rate to come down slightly. They've been happy with that unemployment for a while now. And also the COVID restrictions are coming off, so the actual economy should be opening up more. We've got the RBNZ financial stability report tomorrow night as well. Before that, though, it's the first of the US jobs data. So we're looking through Wednesday and Friday as well for US jobs. We've got JOLTS on Tuesday, then ADP on Wednesday, and then the Friday is the non-farm payroll. So we'll talk about that in a second. The main focus is going to be the ADP. That will be where we'll get a spike in the US dollar, either up or down. Then the sort of week's focus, if you like, and maybe the month, maybe the rest of the year's focus is this FOMC statement. You know, will the Fed rates go up by 50 basis points? Will the statement and then this press conference afterwards sort of hint that they're going to do multiple 50 basis point rate hikes? Are they going to try and get up to 2.75% on their funds rate by the end of the year? You know, all these sort of questions are going to sort of change how the rest of this year sort of pans out. The expectations are that we do get a couple of 50 basis point rate hikes, and then the rest of the rate hikes are 25 basis points. We are expecting to get up towards 3% long-term inflation. So we're looking to see if these rate hikes actually do sort of push up towards the 3%. All those sort of questions will be answered hopefully on Wednesday, and that will have a massive effect on the way the market sort of moves for the rest of the week, the month or year. Looking at the active trader platform, if we go down to the US dollar index, now, since the Fed sort of announced that they were going to go into the rate hike cycle back in the summer of 2021, we've seen the US dollar appreciate. Obviously, there's been a move into the US dollar because of flows out of euro area because of the Ukraine situation. Reserve currency is in demand at the moment, but 104 was a ceiling. We're looking to see if this is going to be profit taking now. If we come back down to the sort of origination of that move around the 97. The 90 sort of level was obviously the base level. If you look back all the way through here to 2015, we had this range, liquidity above, found that, came back down, took that, obviously took out this demand area here when we came down towards 90 the first time in 2018, went back up, so we had a double top. So if we do break up above 104, take out all of that supply that's been sort of dominating this sort of top of the range between 2017 and 2021. If we do get back above that, then we're looking for a breakout, retest, continuation to the upside. However, I am expecting a sort of pullback towards the mean, back towards the 95 at some point. And yeah, I'm not saying that the bears are in control, but we could see the bulls sort of take profits if everything that the Fed says this week is kind of priced in. Looking at the US yields, we can see that the US 10-year yields are up towards 3%. Obviously, if there's going to be multiple 50 basis point rate hikes, that could then push the sort of 1 year, 2 year, 5 year, 7 year higher, which then sort of pushes all the other yields higher. So we could be above 3% by the end of the week, and that will have an effect on the US Forex crosses. Thursday, May the 5th, it's the UK's turn to do something along those lines as well. Bank of England monetary policy report, their bank rate votes. So we're looking to see if there's going to be any dissent within the sort of MPC. And then there's also the official bank rates here, looking to go from 0.75% up to 1%. I am looking for this big weekly candle here from March 2020. This is the sort of demand sort of zone. So if we do get a drop after this, this week's bank rate, I'm only looking for it to come down towards 1.2. And then I am looking for a bounce higher to see if we can take out the supply above 1.45. But we do need the Bank of England to kind of help with that. We need GDP. We need lots of economic data to come out for the pound to actually start to appreciate. Obviously, these rate hikes that we're seeing from the Bank of England are not supporting the pound currently. If it wasn't for the FOMC, I would have said non-farm payrolls are the actual sort of focus of this week. If we go to what's happening in the ADP, so that ADP comes out on Wednesday. Obviously, that's this blue bar chart here, we can see that it's kind of averaging around 500 to 550. Fed Chair Powell says he would like to see 550 to 600,000 jobs per month sort of created. And obviously, if we've got 11 million job openings in the JOLTS data, then we kind of need 550,000 at least to try and fill some of those jobs. So if it wasn't for the FOMC, I would have said the NFP number was going to be kind of important. Obviously, the unemployment is kind of good within the US. So the Fed's mandate, dual mandate, is all focused now on inflation. So that's kind of why we're expecting to see 50 basis point rate hikes. And that is kind of their focus. So that's our focus. Euro versus the US dollar is obviously the most liquid forex pair. It's the most traded. And obviously with the NFP, FOMC, ADP, and things like that, we are expecting to see the euro versus US dollar actually move around. It's currently in a downtrend. It's a daily chart here. So 1.128 is the 200 period moving average. It's below the 9 period moving average here. So if we can get back above that, then I'm only looking for it to go back up to the 1.08, back into this little zone here before we sort of possibly roll back over. The sort of war in Ukraine it's not getting any better, and we're looking to see if we can take out this swing low here from 2016 before moving on down towards parity. So if everything that happens as I expect, yes, the Fed FOMC rates hike is possibly priced in. If we do get a sell-off in the US dollar, like I said, a lot of that will be dependent on this move in the euro, and a lot of that is dependent on how hawkish the FOMC are and how bad the sort of moves in Ukraine are. So at the moment, looking for the euro versus US dollar to come lower eventually, but looking for a little just pop up towards the 1.08, possibly into the 1.1, back into this sort of range here. See if there's that is now acting as resistance. But as there's not a lot of Euro-centric tier 1 data, it is all based on what happens in the US and then how everybody positions themselves for that. Looking at the weekly chart of Brent, we can see that we're in this sort of contraction breakout either side. It could be a false breakout. Obviously, we came off from the high, so I am looking for a continuation to the downside. So we come from the high, consolidate. So I'm looking for a base drop back in towards this trading range here between 85 and 68. So if we can get back towards that, back towards the 200 period moving average, that to me would make the most sense. That would be based on oversupply or lack of demand. So we'll have to look out for data around that. If energy prices were to come down and the dollar was also to come down, I'd expect to see the dollar CAD go sideways. However, we are starting to see that the dollar CAD looks like it wants to go higher, break out of this sort of descending channel. I've got March in red, see if we can pop up to the 1.3, up to the 200 period moving average, maybe into test this sort of zone here between August 2020 and November 2020. That to me looks like it's going to be the most amount of resistance. It's been previous support in the past. So I am expecting a pop up in the dollar versus the CAD, which hints that if the CAD is going to come lower, then that means that oil prices are probably going to come lower out of that pennant that I just showed you. Dollar versus the yen, still in a weekly uptrend, but it has been going up sort of non-stop since 6th of March 2022. Obviously, we're looking for some sort of pullback, some sort of reason for a pullback. If I go to the sentiment indicator, dollar versus the yen, 84% of traders are trying to short this. So even though we're all expecting a pullback, whilst they're still mainly looking for shorts, their stops are going to get taken. So that could actually just keep pushing up towards 135 and take out this supply. If we do that, the origination of that move is probably 115. So we could see a big drop down eventually towards 115. But at the moment, whilst most of the traders on this platform are looking to go short, I am expecting to see this swing high from 2002 get taken out. So once we know all of that data, next week should be a lot easier in terms of trend, but I am expecting a lot of volatility after these big announcements, and then also a quiet market before. So don't get trapped into sort of being pushed long or short, only to have it reverse on the actual statement. Wait until after the actual data drops and then position accordingly after that. Okay, good luck, and I'll speak to you again tomorrow.